Well, good afternoon. Thank you for taking some time out of your day. This is T. Dale with Blue Wealth Management, and I appreciate you joining me for my mid-year live webcast titled Prepare to Land. Today's webcast is an update from my December webcast titled is Deflation on the Horizon. In the December webcast, I suggested that inflation readings would begin to soften and the pace of tightening monetary policy would increase the risk of inflation in coming, or excuse me, of recession in coming quarters. I also noted that I expected to see oil prices and long-term interest rates continue to fall from their peak levels that they reached back in 2022. Presently, oil prices are 45% below their Q1 2022 peak, and while longer-term interest rates have continued to fall since last October. Today's webcast is being recorded and will be available along with the slides for replay. Note I'll be planning a year-end webcast that will include a 2024 outlook again next December. So if you find today's content helpful, be sure to register when the invitation arrives in your email box later this year. Also, if you'd like a copy of today's slides, reach out to me following the webcast. As a reminder, today's content is designed to update clients that include accredited investors of our fund Concilium Capital, high net worth investment advisory clients, as well as qualified plan sponsors and their plan participants. All those housekeeping items out of the way, let's get started. The topics I'm going to cover in this webcast are going to be pretty diverse from each other, but there'll be 6 major items, but they're all interlinked. Number one, I think it's helpful, even though we're halfway through another new year, to go back and do a 2022 markets review. Last year was unprecedented in some important ways, and that's having an impact on my next topic, which is inflation. And I want to talk about this term disinflation and what that means, and then also the prospects for the possibility of deflation being on the horizon. In the third section, I want to talk about interest rates, yield curves and what yield curves are, and what the historical precedent is and influence on recessions. In the fourth section, I'll talk about the banking sector. We're getting questions from clients about should I buy bank stocks? They've been beaten up pretty bad in the last 18 months and are certainly worth taking a look at. So I'll address that when we get to section 4. The fifth section is going to be a little bit more macro oriented. I'm going to spend some time talking about what I call secular bull and bear markets. The term secular is just referring to a long period of time, a decade or more, and looking for the root cause of when we see these periods of above and below average returns from things like the stock market and what's at the root of that. And then finally, I'm going to end on commodities and specifically talk about precious metals and the fact that these markets have started to take the lead in recent years since the pandemic started. So I'll address that and point out some things there that hopefully will give you some good insights. For those of you that are clients, this is designed to talk about advice that I provide in portfolio construction, as well as for those of you that perhaps may not be clients, perhaps give you some ideas that you may want to talk to me about later. So with that, let's go do a 2022 market review for the next few slides. I'm starting this, of course, with the recognition that we would have liked to have known last year was going to be a bear market, not just for the stock market, but for the bond market at the beginning of the year. But since we didn't know that, it's clear to us now that hopefully we're on the recovery side of it. But let's do look at last year, particularly in the light of history. What I've got is some data that goes back to 1928. I showed this in a earlier webcast back at the end of the year. And I think it's very helpful to look at how much of an outlier 2022 was. And what I mean by that is not just that the stock market was down double digits, but also the fact that the bond market was also down double digits last year. By the way, the data that you see on 2022 in the bottom right-hand portion of the chart is actually just through the first 3 quarters. Year-end data improved by the time we got to the end of the 4th quarter. So the S&P 500 index, for example, I think finished down around 16% for the year, while the 10-year Treasury total return of the 10-year Treasury note finished down around 14% of the year. But point being, both of them were down double digits. And notice if you look closely at this chart with me just for a minute, that's never happened before. When you think about balanced investing, what we know is that you want to hold assets that are not directly correlated to each other, which is why investors tend to hold bonds against stocks, because in a year the stock market's down a lot. I'll use 2008 as an example. When it was down 37%, interest rates fell a lot, causing bond prices to go up a lot. So you didn't, believe it or not, lose as much in the same portfolio that's 60-40 and one in the other than compared to what you lost in 2022. And again, further back than that, we'll see some years where both bonds and stocks were down, but they never were down what they were down in 2022. And that's important because that was a big wealth loss last year, and that is impacting the decrease in inflation readings. And that's one of the reasons why I'm bringing this up. How big was the wealth loss last year in stocks and bonds? Well, collectively, there was almost $17 trillion lost in stocks and bonds collectively. Notice that compared to 2008's decline in stocks and bonds, it was more than twice the level. And again, I bring that up mainly because that is contributing to this disinflationary pressure that's now starting to come into the economy, which I'll talk about in the next section. Well, let's talk about this. Is the bear market over? Of course, nobody knows for sure, but I think it's always helpful to look at when you've gone through a bear market, or perhaps you're still in a bear market. Let's get some context in terms of what history says about bear markets for stocks in general. Number one, on average, they last 14 months. Last year's was 9 months from peak to trough. On average, the stock market goes down 35%. Well, what's interesting about last year is that in the first 9 months, the S&P 500 was down about that exact amount from the beginning of the year to the low point in September. But I think it's always helpful to look at too, are there periods of time where you saw greater than those losses over greater periods of time? And I've said this over the last several webcasts, that the environment that we entered into really after the COVID pandemic got going really reminded me of the period of the late 90s when tech stocks did so well. And as for those of you that have heard my webcast before, you know, the FANG stocks really benefited during the pandemic shutdown. And it kind of made me wonder, were we going to see some final blow off move that causes the tech sector to start to lead on the way down? And the tech sector actually did go down more than the other parts of the stock market in general when you look at the sector by sector results, which makes me wonder, are we going to be in a time frame like the March of 2000 to October 2002 bear market, where it actually runs longer than 9 months and goes over a multi-year period? So I'll give you some thoughts on that as we go through some of the content. But what it would look like, for example, I'll look at the NASDAQ index during that time frame between 2000 and 2002. It did have an initial sell-off similar to what it did last year. During that initial sell-off, when the tech bubble burst in March of 2000, you'd see it sell off close to 40%, which was what last year's decline was. And then you'd see these huge rallies that came out of that initial decline of 31% and then 17%. And then you would see it would roll over and rally and roll over and rally and ultimately not decline, or excuse me, not bottom until we were 31 months into it and it had gone down 80%. Obviously, I don't know if that'll be the case again, but what I'm just telling you that I'm watching is if the NASDAQ goes down much below 14,000, and again, this is the NASDAQ 100 I'm referring to, not the NASDAQ composite. And on the S&P 500, if we see it break below 4,000, which would be a little bit more than a 10% decline from its close today, that would start to alert me to start wondering, hey, has this been a bear market rally? And is it the bear market that started in January 2022 not yet over? Let's go into the next topic and talk about disinflation. Obviously, last year and really since mid-2021, we've been experiencing inflation. We know that. That's largely been due to, as many of us know, supply chain issues. It's been also largely contributed by records amounts of fiscal and monetary stimulus during the pandemic. But we did see peak inflation readings in 2022 at 9%. And since that time, inflation readings are starting to come down. And that's important implications that's been helping the stock market, but it's also been helping bonds recover too. So let's go back and remember, what is disinflation? Disinflation is not prices going down. It's just that they're going up at a slower pace than previously. So for example, as I said before, inflation readings peaked on a year-over-year basis at 9% in June of 22. Inflation on a year-over-year basis is now down to around 6%, and it looks like we're going to be trending closer to 4% the balance of the year, which again means prices are still going up, but just at a slower pace. Part of that, I think, is because not just because of what monetary policy is doing and tightening, which again, we'll get into that, but I think it is in large part starting because of the negative wealth effect, going to that $16+ trillion of wealth lost last year that's contributing to slower spending. So, and I'm looking at that, what's on this chart is personal consumption expenditures. And there's a historical lag effect to what you see when you have wealth losses on the influence of personal consumption expenditures. And that's suggesting that that trend will perhaps go for another year, which will help bring down the inflationary pressures in and of itself just from last year's wealth decline. And when you think about why that happens, if you take investors, for example, say you're an individual that's living on nothing but your financial assets. If you see a big decline in your wealth, chances are you're not getting ready to go make a big expenditure. You're going to wait for your wealth to recover. Maybe you're going to take a big trip and maybe delay that until your wealth recovers. If you're a big pension fund, now you're underfunded, or maybe you're more underfunded. You might be using some of the resources in your taxable budget to go to reshore that pension fund. So that's all I'm suggesting to you, is that when you see wealth declines on the magnitude of last year, that will likely contribute to disinflationary pressures due to this personal consumption expenditure decline that looks like it'll continue through another year. Another contributor to what I think will be disinflationary pressures is the decline in the money supply. Now, we know that the money supply tends to go up year after year, but what I'm looking at again is the rate of change in the year-over-year number and the influence that happens to have on inflation. So let's go over that just for a minute. The gold line is the year-over-year change in the money supply. So again, just as a reminder, during the pandemic, we saw a vast amount of fiscal and monetary stimulus that caused the money supply to go way up when we were all in lockdown. And then about 16 months later, what we now know is the year-over-year change in the inflation data through the CPI index went up a lot. And what we see now is the year-over-year change in the money supply is coming right back down, which is suggesting that in coming months, so should the measured rates of inflation. So let's look at that through the context of history. Again, I've shown this chart before. When you look at peak inflation readings and how long it takes to get to a future trough inflation reading, I think it's helpful to go look at all the past episodes you can find. And these are all the dates of peak inflation readings going back to 1951, what they were right here in this column, and what their trough inflation reading. And then down here was the average period it took, or amount of time it took to get to the trough reading, which is about 25 months on average. So again, if last year in June of 22, we had a peak inflation reading at 9, that suggests that on average, history says don't look for a trough in inflation until next summer. How much should inflation trough at? If 9 was the peak, history says you ought to expect an average drop of 7 percentage points, which means that the Fed may in fact get its way at a 2% inflation reading before we see its final low. And the implications of that is, of course, is that the Fed's feeling like if they're right in raising rates, that they're going to have done their job to get inflation down to their target, and 2% is their target. Speaking of the Fed, let's talk about the Fed, because the Fed really has only a couple of tools in their tool chest to influence inflation. That's why I've got this picture in front of you. The Fed policy is almost like a hammer, which is a limited tool, and you might be needing other tools in your tool chest. But really what the Fed does, of course, is they try to influence inflation by raising the short-term Fed funds rate that banks borrow and lend to each other, by raising and lower it. But then they can also do one other thing, which is changing the dynamics of their balance sheet. So we'll talk about that, and then we'll talk about the signal that we're getting from the yield curve, and I'll talk about what that is if you're not aware of what the yield curve is, and then also the implications of that for the prospects of a future recession. So first, let's look at the Federal Reserve's interest rate hikes and go back over last year's hikes, what they've done so far this year as it relates to the borrowing and lending costs for overnight lenders between the banks. So number one, the Fed started raising rates March a year ago, they raised 25 basis points. That's 0.25%. May a year ago, they raised 50 basis points, or half of 1%. And then June, July, September, and November, they went 75. Now, the point of bringing that to your attention, in addition to, by the way, in December, they did another 50. That's the quickest and most drastic tightening of monetary policy going back to the 1970s. They've moderated their tightening policy this year so far in 2023 by only going up 25 basis points. That was in February, March, and May. They just this week decided to pause, but rate hikes are not guaranteed to be over, according to what Jerome Powell's report said. And so they know that they're trying to get inflation down, but two, they're also trying to create expectations that they may not be done yet. So let's look at some other things the Fed has done to try to tighten monetary policy. Let's look at what their balance sheet, along with the balance sheet of other central banks, has been doing. And I mention that because that's important. When you go back to when you think about when we were in the lockdown and we had all that stimulus, and when I say all that stimulus, let me again remind you, that was $6.5 trillion of authorized deficit spending to give us PPP loans, to give us checks for staying at home, to provide money to the healthcare sector. That was on the order of 25% of our economy's output in a year. That's more than what we would have spent on a percentage terms basis back in World War II. And we did that in like 15 months. And the Federal Reserve monetized a lot of the deficit spending. In other words, a lot of that $6.5 trillion of deficit spending, which meant that you had this huge liquidity effect, which is why you see this big increase, not only in the balance sheet of the Federal Reserve, but also other central bank balance sheets. And my point is that today, not only have they been raising rates, but they've also been letting their balance sheet run off, which is another tightening effect, is the point to the liquidity environment that we're witnessing in financial markets. And that's not stopping yet. So what are the chances that we're going to have a recession? Because not all Federal Reserve tightening cycles have led to recession, excuse me. So let's look at the circumstances around when you didn't have a recession, when you did have a Federal Reserve tightening cycle first. So number one, that was in the 1960s. The Fed raised rates and you didn't get a recession. It happened again in the mid-1980s. It happened again in the 1990s, in the mid-90s. And then again during the 2016 to 2018. All those were periods of time where you saw tightening monetary policy from the Federal Reserve, but you did not get a recession. Now let's talk about the circumstances where you always did. That was when you had a tightening cycle from the Federal Reserve that was in conjunction with a spike in the food and energy prices on a year-over-year basis, which is exactly what we've just witnessed. We've seen food and energy prices go up over 20% on a year-over-year basis. And if you'll notice the previous episodes where that happened, that was in 2008. Oil briefly got to $150 a barrel, and the Federal Reserve was tightening policy. That gave us the great financial crisis. Hopefully don't see that again. You saw a less deep recession during 2000, but nonetheless, it was a 30-month bear market that took the stock market down 50%. Prior to that, in 1990, you saw a recession. The stock market didn't go down much at all, but the economy did go into a recession. That was about like 2001. And then you did see in 1980, two recessions that were back to back. Those were stock market declines, not dissimilar to what we saw last year. Then you had the 73, 74 episode. We had a spike in energy prices and the stock market would go down 50% over 24 months. And then the 1970 recession. So all I'm trying to suggest to you is that this go round, we're seeing a tightening cycle in conjunction with a spike in food and energy prices. And so since our country is 70% based on consumer spending, when the consumer gets pinched, that typically means less consumer spending. Raising interest costs and financing costs is another thing that's going to crimp consumer spending. So it seems likely that because in the current episode, we have the same circumstances that always led to recession, we need to be keeping in mind that's a pretty strong possibility we're going to see one. Of course, the question is the stock market already discounted it or not? And I'll get to that in a minute. First, let's talk about yield curves. What's the yield curve? The yield curve is just simply looking at the rate of interest an investor gets say loaning the government money for 3 to 6 months, all the way out to say 30 years. What's an inverted yield curve? An inverted yield curve is simply when you see short-term interest rates like they are today, well above the longer-term interest rates. So for example, today, I know I can go buy a money market fund and make close to 5% liquid every single day because the 3-month yields are up around 5%, or I can buy a 1-year treasury note making close to 5%. But I also know that if I go out and buy a 10-year treasury bond, I don't make that yield, I make 3.6%, which begs the question, well, why would I buy a 10-year treasury bond with a lower yield per year when I can make a higher yield per year and something shorter term? And the answer is if you don't think those short-term rates are going to be sustainable at those higher yields, the longer-term rates at lower yields can actually give you comparable return over time, and perhaps even more return over time on a total return basis if the entire yield curve goes back to, say, for example, where it was in 2021, where all the rates start to fall. I'm not sure that that's going to happen anytime soon, but I would say that that is the context of what happens during recessions, is that you'll see the short-term rates start to fall back below the longer-term rates. The longer-term rates knew that already. The Fed will follow with loosening monetary policy eventually. And again, I'm not saying that's my forecast yet. I'm just saying that's the historical observation of why investors buy a longer-term dated paper that has a lower yield than, say, shorter-term paper. Let's look at these yield curve inversions and the influence on the stock market. What's interesting about looking at the yield curve, and by the way, which one's the yield curve is a fair question. The yield curve, we're looking at the difference in yield between the 2-year treasury note and the 10-year treasury note, which again, the 2-year treasury note's up closer to north of 4, the 10-year treasury note's at around 3.6. So anytime you have a yield curve inversion, that means that short-term yield is above the long-term yield. And so therefore it's negative when you take the shorter one less the longer one. And when you have a negative yield curve, that's often a precursor to a recession. That's the bond market signaling that the Fed's being too tight with monetary policy and they're eventually going to be forced to loosen. So when the stock market does well, historically, you're usually starting with a vantage point of the yield curve being extremely steep, where those short-term yields are well below the long-term yield. So for example, when you look at the yield curve back in the early mid-90s, when it was up here at 2.65, notice the blue line, which is the stock market using the S&P 500 index, is doing quite well. It's appreciating nicely, all the way up into the point where, guess what? The yield curve gets pretty inverted, which is what happened when the tech bubble peaked in March of 2000. Well, guess what happens? The yield curve goes from being steeply inverted to very steep after the stock market's gone down 50% over 30 months. And guess what? Now's a great time to own the stock market again, because you have a steep yield curve, and that lasts for about the next 5 or so years, all the way till we get another inverted yield curve. That happened in January of 2007. And I would like to note that the stock market did not immediately go down. It went up for another 9 months, but eventually would be succumb to the great financial crisis and go down 58% over 18 months. But notice once the yield curve got extremely steep again, that was a good time to own the stock market. And that's the bond market signaling that the financial system's healthy again. Borrowing and lending growth is usually happening when you have a steep yield curve. You also usually see the Fed funds rate loosened quite dramatically, which, by the way, the Fed funds rate is this green line at the bottom. So again, when the Fed funds rate's going up, that's the Federal Reserve tightening policy. When it's going sideways, the Fed is pausing policy. And then when it's coming back down, that's the Federal Reserve cutting those short-term overnight lending rates, trying to provide stimulus back into financial markets and ultimately the economy. Today, we're actually in real time up above this 5% level at 5.25. So I'd just say that the yield curve is telling you it's a little early to start hoping on the stock market having bottomed back last September, because there's not any history in this chart that's telling you that the stock market's going to have legs to go to new all-time highs. Not to say it can't rally in the near term, as long as it's this inverted. Now let's address the financial sector. Is the banking sector, after being beat up pretty good last year, a buy? Well, let's talk about a couple of things we know about the financial sector. And I'm focusing on banks here for a reason, but really this is applicable to the insurance companies and other parts of the financial sector in general. When you think back to 2008, all the way through 2021, what we know is that we were in a historically low interest rate environment. And so for banks in particular, banks didn't have to pay depositors hardly anything to keep those deposits with their financial institutions. And the relevance of that is simply this: a bank could make a loan at 3.5 to say 5.5, maybe even 6%, and make a nice net interest margin spread on that loan that they're making relative to their cost of deposits to keep the money in the bank. And then 2022 shows up and rates go up a lot, causing the value of their loans to go down, which is what you're seeing here in this chart. Those are the parts of their fixed income portfolio that's experienced realized losses to the tune of $675 billion last year. And now investors, or excuse me, savers, are starting to ask their banks, hey, if you want me to keep my money in my checking account or my savings account, you need to start paying me interest, or I'm moving to a money market fund. And to illustrate that and to show you the yield difference, it's been pretty wide. And again, this is not because banks are being stingy. Banks are just simply trying to manage their loan books because they've got so many loans on their books from the last 3 and 5 and 10 years that are at these lower rates, and they can't afford to pay depositors, above the rates that they've got their loans outstanding or anything close to it. It's going to kill their net interest margin. So savers are pulling their money out of savings accounts and checking accounts, going to money market funds, because you can make over 4.5% in a money market fund, and your average savings account rate is substantially below that, typically 25 to 40% of that level. So what does that mean for the banking sector? Well, banks have lost nearly $2 trillion in counting just in the last 12 months to money market funds. That doesn't mean we're going to have a banking crisis, but it is something to keep your eye on, because the longer that goes on, the more that's going to pressure the banks to reduce their loan portfolios, which will further tighten credit conditions in the economy. So is the banking sector a buy? I would say not yet. And I'm looking at one component of this chart. What's in the top is the bank index. And as you can see, the bank index of stocks went down a lot from the peak in late 2021 through really even this year, even though they've been rallying recently. But what I would be looking for before I would buy a bank stock is I would be waiting for high yield spreads to blow out. What do I mean by that? I want to see some type of high yield crisis go on in the junkier parts of the debt market. And the reason why I say that, if you go back to 2015, you would see investors get nervous and high yield spreads would go up to over almost 9%. And guess what? Bank stocks went down into that moment. But then once they reached that high level of 9%, you see bank stocks recover quite nicely. More recently, during the pandemic, that first quarter when we were all shut down in March of 2020, high yield spreads blew out there. They got up to almost 8%. Bank stocks plummeted dramatically, but would become a good buying opportunity at that point. So again, only because we've not seen high yield spreads blow out yet, I would just simply suggest I would wait to that moment before I would get interested in shopping around for bank stocks to buy. What's another reason why I might hold off and looking at bank stocks? Banks are correlated to the S&P 500 and are inversely, as a result of that, correlated to the yield curve. So if you think about it, the S&P 500, what we know is back during the tech bubble bursting, when the yield curve went from deeply negative to dramatically positive, the S&P we know went down. Well, guess what? So did bank stocks. They would go down 43%. More recently, during the 2008 financial crisis, we knew they would go down 85%. It's not my base case, certainly not my hope, but I'm just suggesting to you is that until the yield curve gets very steep, I would just suggest to you another reason to hold off on looking for bank stocks to buy. Now let's go into the next section. Let's talk about the root cause of secular bull and bear markets. and the implications of that on things you may want to own within the equity portion of your portfolio. One of the things, if you talk to anybody in our industry that's in financial services, is that over long periods of time, stocks historically average 11%, which is true. If you go back far enough, you can find, particularly over any 50-year period, stocks in the blue chip indices like the S&P 500 will average around 11%. The problem is nobody has a 50-year time horizon typically to hold them. We all have time horizons that are anywhere from maybe as little as 5 or 10 years to maybe as far out as 40 years if we're in our 20s, saving our 401k plans. But I think it's helpful to look at the periods of time where they do better than that average of 11 and what's causing it, at least in my view. And then what are the periods of time where they do below that average, and in my view, what's causing that to happen and where we are likely today. So let's go back to 1948. Let's go for a little drive through history. What's happened in 1948, we know, for those of us that know our history, is that we've just come out of World War II. The world's going to peace, which is a good thing. The 2 previous years of that, during the war, we had a lot of war-related spending. And what we know about war spending is that tends to be inflationary. And since it was a world war, there was a lot of it. But once the war was over, all that war-related spending would go away. And as a result of that, inflationary pressures would come down. And when inflationary pressures come down, that means one thing: if you're a central bank, you don't have to be as restrictive as monetary policy as you would have to be otherwise. So what did we get? Well, we got a great period during the stock market. You're looking at the stock market, by the way, through the lens of inflation. This is the S&P 500 divided by the PPI, or the Producer Price Index, which is one of the inflationary gauges. And I like to use it just to reflect the impact on the stock market that inflation had in that period of time. And what you can see is that from 1948 through the late 1960s is pretty much a straight up run. And an investor in the US stock market didn't just make 11% per year during that period. They actually made a little over 16% per year, which of course anybody would enjoy that type of circumstance. Another period to point out where you saw favorable returns from the stock market as a result of inflation being at bay was after the 1970s and early 1980s. For those of you that remember, we had inflation in the 70s and 80s get out of control. We saw high and rising interest rates, high and rising commodity prices. We saw multiple recessions. But once 1980 got here, you saw all of that stop. Inflation and commodity prices start to trend lower. As a result of that, interest rates started to trend lower for the next 18 years. And as a result of that, monetary policy got to be a lot looser than previously. So you didn't see many recessions. And guess what? The stock market appreciates from 1982 to March of 2000, not at 11%, but at 18% per year, but this time for 18 years. So unbelievable a period of above average performance. The most recent one, post 2008. Remember in 2008, right around July, oil peaks at $150 a barrel and then crashes in the financial crisis. Monetary policy quickly loosens, fiscal policy bails out the banks. From the October low of 2008 through January of 2022, generally speaking, you're not seeing recessions because of low to falling commodity prices. And guess what's going on in the stock market? Above average returns, above that 11%. That's about 16% per annum during that 13-year period. Now, here we are, it's 2023. Are we still in that environment that produced those types of circumstances? Well, it depends on your view of inflation, commodities that will result in monetary policy. So if you conclude that you think that we're going to see commodity-related inflation stick around, and then it's not just a temporary phenomenon from the COVID-related stimulus that's resulted in supply chain related issues, if you believe that commodity price inflation may trend like it did during the 60s and 70s and in the post-tech bubble 2000, then you want to necessarily also assume that monetary policy is not going to be loose as it would be otherwise. And the reason why I bring that up is that that means this decade, if that's your outlook, is going to be more prone to recessions than previous decades like post-2008 through 2021. So that's why I put this period in here in front of you along with the 2000 to 2008 timeframe through the lens of inflation, because as you see, even though the stock market in nominal terms is kind of treading sideways, not going anywhere from, in this case, it was 16 years in the 66 to 82 period. 2000, 2013 was 13 years before it broke out permanently. I would just suggest to you that you need to be rethinking your equity exposure, because there are areas that can do well in those circumstances, and it's the areas that benefit from rising commodity prices. Things like energy stocks, things like commodity positions in and of themselves, things like precious metals, mining companies, which we'll talk a little bit about in more detail. But before I do, let's talk about why the tech sector, which has got some wonderful names and wonderful companies that's making our lives all vastly improved, is vulnerable, and why and when that's been the case in the past. Well, when you look at the tech sector size in relation to the overall stock market, again, using the S&P 500, what you're seeing today is it's at previous peak readings, meaning that the names have gotten so big because they've done so well. You're seeing a point where in at least the two previous episodes, hey, look out, those are companies that, as good as they are and as much benefit as they're providing to society, they're likely overpriced relative to the other components of the market. That happened again in March of 2000, but it also happened in the 60s before you saw that inflationary period start in both of those episodes. So what are the names and what are the indices that I'm referring to specifically? Well, let's take the top three of some of the main top indices like the S&P 500. If you look at Apple, again, a great company, Microsoft, also a great company, and Amazon, not so much a tech name, a consumer discretionary name. Those three names, if you buy an S&P 500 index today, are going to get 15% of your money, actually closer to 16% of your money. And the other 497 names are going to get the rest. Now, I mention that because when any one stock historically has ever become a 5% or greater weighting in an index like the S&P 500, that's usually telling you there's froth in the index as a whole, and you're maybe close to a major peak in that index that could wind up being a multi-year peak. Let's look at another index where there's high tech concentration to it. If you look at the Russell 1000 Growth Index, it's also got the same three names, but notice that the way it's weighted, you don't get just a 15% or so weighting. It's actually closer to a almost 30% weighting of those three names. So again, the other 997 names are getting the other 70% of your money. So you're really dependent upon those three names if we're using those two indices. Now let's go to a much more broader index, like the total US stock market index. It's actually got 5,000 names in it. You might think, well, if I use that, surely that'll diversify me more. Well, believe it or not, you're still going to get a greater than 5% weighting in both Apple and Microsoft, and still have a 2.5% weighting in Amazon. Again, I'm not saying these are bad companies. I'm just saying they're very richly priced. And history just suggests that if you believe you're going to stay in a sticky inflationary environment that's going to lead to tighter than normal monetary policy for longer than we might expect, those names are probably going to be the most vulnerable to drawdowns. Well, what are the things you can do? If you want to keep equity exposure, what are some ways to weight your equity exposure so that you have better protected names that are not quite as expensive as the names that are the big cap tech ones? Well, first, let's take a look at the free cash flow yield that those traditional indices like the Russell 1000 and the S&P 500 are generating by the way that they're weighted. Notice that the free cash flow yield coming out of the Russell 1000 index of companies today is below the risk-free money market rate by a considerable amount. I said earlier, you can make close to 5% in the money market. Today's free cash flow yield being generated by the entire index of the companies in the Russell 1000 is below that by a large margin. That's telling you in English that you're not being properly compensated for the risk that you're taking. Well, what's a better way to approach it? Look and screen for companies that have higher free cash flow yields. There are companies out there that have free cash flow yields as high as over 12%. Those companies and their names are far likely to protect you in the environment that we're in on a going forward basis. And those are some things I would encourage you to talk to myself or one of my other partners about implementing in your portfolio if you're looking for equity exposure that has better yield protection to it and also lower PE ratios. What are some other things? I've mentioned commodities and gold, and then the new market leaders. Let me first of all give you some context about gold and commodities in general. Number one, they tend to have these long periods of time where they do nothing but go sideways, perhaps even down for a decade. And then you see these periods of time where they make up for it and look like they're going straight up. The time that you want to own those two asset classes is after they've done pretty much a sideways to down type decade, because history suggests that they're about to make up for it, particularly if inflation is going to stay sticky. But what's interesting about gold, I want to use it for just a minute, is that if you go back to 1970 when we got off the gold standard, believe it or not, gold has actually compounded at a rate of return equal to the overall stock market at 11%. It's just that it's not near as consistent of a return generator as the stock market tends to be, and it actually tends to do opposite the stock market. In other words, when the stock market's doing well in one of those periods like 1980 to 2000, gold's usually flat to falling. Similar to 2011 to really even more recently to this past year, gold's flat. And so when you see gold and commodities do well, it's usually in these inflationary periods where you're seeing the stock market stay flat and they're actually the ones that are taking the lead. But let's look at it in fairness to both through a period of time where gold's gone sideways and done well. And what's interesting about that is that if you go back to March of 2000, which was the beginning of a poor time frame for the stock market in general because the tech sector for a decade, followed by a period of above average returns. And then with the gold price going well on the front half of that period and then poorly on the back half, it's interesting that gold has still outrun the S&P 500 index on a total return basis, which is not to say permanently allocate some of your capital to the precious metals. It's just to say that the evidence is there that it does play an important role. And I think it's an important diversifier to an overall asset allocation, which is why I personally use it myself and encourage my clients to use it. How does gold do during a recession? If we've got a recession risk, will it protect me? That's a reasonable question to be asking. So let's take a look at it. Now let's look not just at gold, let's look at silver, let's look at stocks, let's look at commodities, and let's look at precious metals mining stocks. And let's look at it through the different phases of a recession. It's usually phase one of a recession, which could be where we are today, where monetary policy is still tightening. You hadn't seen monetary policy yet paused, at least not for sure, much less monetary policy starting to loosen, which tends to happen in the back phases of a recession. So let's look at and start with gold. Gold tends to goes up in that first phase of a recession close to 11%, followed by in phase two, historically close to 6%, and then it flattens out in phase three, and then in phase four and phase five. Silver, interestingly enough, has a pretty big jump in the first phase of a recession and then flattens out and goes down in the middle and then starts to pick back up, typically once you start to see monetary policy loosen. Stocks in general, again, when I say stocks, the S&P 500 types of stocks tend to go down in the first three phases of recession, but then once the recession starts to get properly discounted through the loosening of monetary policy, you'll often see the stock market start to recover well before the recession is over. Commodities in general, when I say commodities, any commodity index is going to have a big weighting to things like oil and industrial metals. So when I say commodities, think of those things. You'll tend to see commodities start to rise in the first phase of a recession, but then they'll start to give it back in the middle phases and then recover as the economy starts to get stimulus, presumably from both fiscal and monetary policy. And then finally, let's look at how precious metal mining stocks do, because what's interesting about that is that they, like gold, tend to do well of all but that middle phase during a recession. So far what I've told you is that gold, silver, and precious metals mining stocks actually can act as a good buffer during a recession if you're looking for ways to protect yourself from an oncoming recession if you're worried about that risk. Now let's talk about how precious metals mining stocks can do in an overall secular bull market for commodity prices, because precious metals mining stocks, which mine gold and silver, are going to be highly tied to commodity prices rising over time. So I think it's helpful just to look at these time frames, because when you're in a commodity bull market, precious metals mining stocks can go anywhere from 7x to 18x from low to high. Also, let me be very quick to say that once that high is in, you do not want to own them. They will go down 80+% every single time, which is what they did from 2011 through the end of 2015. And then they also did it from, I believe, the peak in 1980 through about 1990. I think it was around 1990 or 91. So right now, precious metal mining stocks are still cheap. I'll tell you why that's the case in a minute. There's probably a lot of upside still there in that sector. And the reason why I believe that to be the case is that going back to, we're looking at the best sectors to own based on free cash flow yields. These are free cash flow yields ex inflation, in other words, stripping out inflation. And if you notice, the gold and silver mining stocks actually have the highest year-over-year change in their free cash flow yields net of inflation. So they're arguably the cheapest sector. I'm not saying to go put all your equity exposure there. It's just to say that that's a good place to be from both a value, and if you happen to believe that we're in a commodity upcycle that should benefit gold and silver, that's an argument for owning some exposure there. What's a final argument for owning some exposure there? Well, let's see how they do when the yield curve goes from deeply inverted like it is to exceptionally steep, like I'm assuming that it's eventually going to do. So again, just a reminder, what's the yield curve? Is the difference in the rates between the short-term 2-year note versus the 10-year treasury yield. And when it's up here above the green line, that's telling you policy is loose. Banking and lending is likely growing. Monetary policy is probably loose. And when it's negative, like it is right now, that's just suggesting to you that monetary policy is tight, financial conditions are restrictive, your economy is vulnerable to a recession. Now, if you believe that the yield curve is not going to stay inverted indefinitely, which it never has, and it's eventually going to steepen, let's look at how precious metals mining stocks does on that path from being restricted to loose. The gold line is the precious metals mining stocks. Here it is in November of 2000. The Huey index goes from 35 on the index to, by the time it's up here, and that's 36 months later, it's gone up 700%, while the stock market has gone down 50%. Pretty good rate of return and a pretty good protector to those assets that may have gone down. Let's go to the next episode. During 2007, the Huey index had already been in a bull market because commodity prices had been rising for 7 years. So you didn't get quite the protection, but it did go up 50% before it ultimately go right back down with the overall financial crisis. But ultimately, by the time they peaked in 2011, you would see the precious metals mining sector from this moment of where the yield curve was at its maximum inversion, you'd see it more than double. So what I would suggest to you is that where the precious metals miners are today, they are not starting the beginning of a commodity bull cycle in my estimation, but they're not as far along as where they were by 2007. And I would submit that we ought to expect something in between the 2000 to 2003 outcome. In other words, something that's not sevenfold during a recession, but something that's not a double either, something in between, if history is any guide. Obviously, that's no guarantee. I'm just saying that would be my base case for what I'm doing with my money. All right, so in summary, are we going to see a soft landing? I wouldn't position for it. That's not to say don't own stocks. Just be careful about the kind of stocks that you own. Policy's tight. We've seen a big year-over-year change in food and energy prices. That's always meant we would see a recession. Will it be deep or shallow? Nobody knows. It's completely possible it could be a shallow recession like it was in 2001, but that doesn't mean that the stock market doesn't have a more prolonged bear market in general if you own those tech heavy indices. Let me close with some additional resources that some of you may have an interest in on some additional topics. The first is from the best money manager I've ever tracked, and that's Stan Druckenmiller. I say the best money manager only because he ran money for 30 years, and his compounded annual growth rate for he and his investors was in excess of 30% per annum for those 30 years, and he had no down years. So if you ask me for a set of my slides, I'll send them to you, and you can click on this link and you'll get a 6-minute interview of what he sees going on in the environment currently. Another topic that may be of interest is the dollar and its reserve currency status. Number of questions we're getting from clients is, what are the implications of the dollar losing its reserve currency status? What are your thoughts on that likelihood? And there's a good article JP Morgan put out on that subject that I'd offer to you to read. Another subject that may be of interest to some of you is the possibility of going back to some type of gold standard. I think it may be of interest just to be aware that the world's 7th largest economy, which is the state of Texas, actually has that very thing being considered in their state legislature. If you click on that link, you can see where that is and follow it. And when I say Texas, I'm just saying Texas is thinking about putting in place the ability to have a gold and silver backed digital currency that you can actually use, no different than any other digital currency to buy and sell and transact in. Another item that may be of interest that's more macro oriented on financial cycles and debt productivity is from Lacey Hunt's quarterly review. He's with Hoisington Management out of Austin, Texas. I've had the privilege of eating lunch with him twice, and he to me is one of the greatest living economists in terms of market knowledge and history. And I think that may have benefit of some of you that may be of interest there. Final housekeeping notes, as I mentioned at the beginning, I'm planning my year-end webcast Thursday, December the 14th. If you're interested in that, just be on the lookout of the webcast email that'll go out later this year, closer to date. Finally, in closing, let me mention this for the different investor types that this webcast is likely to be viewed by, which includes 401k investors. Number one, if you're a 401k investor directing your own account, what are the implications to you? Number one, to the extent that you own high quality bond funds in your account, my advice is to still keep them. Bond prices to me, particularly high quality bond prices, are still attractive currently. Number two, make sure you own value over growth to the extent that you own equities. And three, to the extent that you have access to precious metals, stocks, that's some exposure that's worth having some money in. Not all your money, but some money. Also, for clients that are investment advisory clients and clients that are clients of our fund, Concilium Capital, if today's review and market update makes you want to do an account review, don't hesitate to reach out to me after you watch today's webcast. For 9 clients, if you'd like to explore how to put some of these ideas to work for you for your investment management needs, let me or one of my other partners know. We'll set up a time to explore how these thoughts can help you manage your risk and opportunities in light of your investment objectives. In closing, hope you and your family have a great summer and July 4th celebration in a few weeks, and goodbye for now.